Hello everyone, and a very warm welcome to our classroom today. I'm your host, and today we're going to dive deep into the true mechanics of the stock market. We're going to look way past those simple green and red shapes flashing on your screen, and we'll decode the actual auction theory behind every single candle. For a lot of you, this is absolutely going to change how you look at charts forever. By the end of this explainer, you'll know exactly how price really moves, and more importantly, how the smartest institutions read these exact same charts. So get comfortable, clear your distractions, and let's get started.
So let me ask you a very common and probably painful question. Why do your stop losses always seem to get hit? We've all been there, right? You do your analysis, you spot this perfect geometric pattern, you confidently enter on the breakout, and then, almost instantly, the market sharply reverses. Your stop loss is hunted, and you're just left staring at the screen thinking, did the operators know I was there? Were they waiting just for my trade? It's incredibly frustrating, isn't it? Well, let me assure you, it's not bad luck at all. It's simply because you're trading an illusion that's been painted for you, rather than the reality of the market structure. Let's understand why this actually happens.
This brings us to a foundational truth that every professional knows. The stock market is not a guessing game. It works exactly like a giant continuous auction. Think of a bustling local market where people are actively bidding for an item. Buyers are constantly bidding higher prices to get it, while sellers are offering it at lower prices, desperately trying to find a buyer. The exact moment both the buyer and the seller agree on a fair price, a trade happens. Thousands and thousands of these tiny agreements happen every single second, and they build the very candles you're studying. Every candlestick is literally just a visual story of this agreement or disagreement between buyers and sellers at a specific moment in time. Let's break this down by looking at the pure anatomy of a candlestick. Notice the solid, colored part, the real body. The real body shows us what we call acceptance. It represents the price range where both buyers and sellers were completely comfortable trading with each other. They accepted this zone as fair value, and a lot of trades happened right there. But look at those thin lines on the top and bottom, the wicks or shadows. These represent rejection. A long wick means price briefly went to that level, but one side strongly disagreed with that price, and they aggressively pushed it right back toward fair value. To put it simply, the solid body is where they agree, and the wick is where they fight.
Now, when this fight between buyers and sellers becomes completely one-sided, we get our next crucial concept: imbalance. Imbalance happens when massive, overwhelming buying or selling pressure hits the market, forcing the price to move very quickly to find a new fair value. I want you to picture a giant iceberg floating in the deep ocean. That small, jagged piece of ice you see above the water, that's just the visible price moving on your chart. But beneath the surface, completely hidden away, are massive, heavy orders from large institutions. They're the only ones with the capital to create these huge imbalances. If you only trade the visible tip of the iceberg, your trades are definitely going to sink. You have to learn to read the unseen pressure underneath.
So how exactly do these big players use that massive iceberg beneath the surface to trap impatient retail traders? Well, imagine an uptrend where the buying momentum is finally starting to die out. The big players are sitting on massive profits, and naturally, they want to book them. But to sell millions of shares, they desperately need a huge pool of buyers. So what do? They allow a recognizable structure to form, something like a classic bearish flag pattern. Retail traders see this breakout and they immediately jump in to buy, hoping the rally continues. But guys, it's a carefully laid trap. The market is already exhausted and facing strong resistance. The retailers blindly provide the exact liquidity the big players need to dump their heavy shares, causing the market to sharply fall.
Okay, so how does a professional handle this exact situation? Notice the patience of the smart trader here. The smart trader doesn't rush in blindly on that initial tempting upward breakout. They understand the broader auction context. They know that after a massive run, that upper swing is fundamentally weak and lacks genuine institutional support. So instead of taking the bait, the smart trader just patiently waits for the breakout to fail. They know that trapped retail buyers have anxiously placed their stop losses right below that breakout candle. The smart trader confidently takes a short position exactly where the big players are hunting those retail stop losses. They're trading the true reality of the auction, not the manufactured trap.
This really reveals a fundamental difference in psychology that completely separates amateurs from professionals. On one side, we have the new trader. They're entirely impatient. They trade blindly on basic geometric shapes without understanding the underlying auction context, desperately jumping at every support or resistance line, hoping for a quick profit. On the other side, we have the smart trader. They possess deep, unshakable discipline. They focus purely on market structure, they always wait for proper confirmation, and they strictly follow the heavy footprints of the big institutions. Remember, losses are rarely just bad luck, they're basically the tax we pay for our own impatience. We absolutely must train ourselves to abandon this impatience and think exactly like the smart trader.
Let's look at how dangerous this is in a downtrend scenario. The market has been falling heavily for days, the massive sellers are in deep profit, and now they want to completely exit their short positions. But to buy back their shares and book profit, they need fresh sellers. So the market approaches a critical support line and a sudden breakdown happens. The impatient retail trader sees this and aggressively enters a sell position without waiting for any confirmation at all, fully expecting a major crash. But this blind selling is exactly the fresh liquidity the big players were waiting for. Instantly, the large operators buy heavily against the retail sellers. The price reverses violently upward, flying straight past the breakdown candle and triggering all those retail stop losses. This is the absolute danger of trading without confirmation.
Let's carefully break down this unseen auction sequence step by step so you never get caught completely beneath the iceberg again. Watch closely. Step 1. The established trend loses its momentum. The smart money simply stops pushing the price. Step 2. These large institutions need to book their massive profits, but they need fresh liquidity so they don't crash their own price during the exit. Step 3. They intentionally allow fake textbook patterns to form, basically sending out a loud invitation to retail traders for blind, early breakout entries. And finally, Step 4. Once the retailers are fully trapped and their capital is committed, the big players aggressively reverse the market, sweeping the stop losses for that needed liquidity. Once you master this specific sequence, you stop trading simple shapes and you start trading the actual market reality. All right, let's do a quick, definitive recap of the core rules of auction market theory we've deeply covered in our explainer today. Rule 1, the market is a continuous auction, nothing more, nothing less. Rule 2, acceptance, which is visually shown by the real body of the candle, represents fair value agreement. Rule 3, rejection, visually shown by long wicks, represents a strong, aggressive disagreement by one side. Rule 4, imbalance is that aggressive institutional pressure relentlessly searching for a new balance point. And the absolute golden rule, every single candle tells a crucial part of this ongoing story. Stop just memorizing geometric patterns and start reading the continuous battle between buyers and sellers. And that brings us to the end of our lesson today. Remember, in the stock market, there are absolutely no absolute guarantees, only probabilities. You must always confirm your reading of the auction with solid price action. And above all else, you have to practice very strict risk management on every single trade. So I'll leave you with this question to ponder. Are you going to continue being impatient, blindly trading the illusion the big players want you to see? Or will you develop the discipline to read the auction, track the liquidity, and trade the reality? The choice, my friends, is entirely yours. Thank you for joining me in this explainer, and I wish you happy, disciplined learning.